Thank you for your time today. Before we start with an acknowledgement of country, and we recognise the Wabanaki Confederacy of the lands we meet today, but we also acknowledge the Kaurna people from the Adelaide Plains from where we're visiting you. So today, I'd like to introduce us. We are CBS Advisory, and we're looking at ensuring that the family's values and vision result in sustainable and profitable profitability, ensuring intergenerational wealth and influence continues. So we know that these are uncertain times, and there's a level of fear that we're all going through. And it's because of businesses like yours and the innovation that you're going through, and even the example that you set by the way you treat your staff. It brings comfort to everyone, and it really makes a huge impact on what the whole world is going through at this time. So I'd like to start off by introducing the team. My name is Ben, and I'm the Family Business Specialist. I've got Caroline, who's our Business and Financial Specialist, and I've got Simonette, who's our Sustainability and Strategic Specialist. So what are we going to do today? We're going to discover what's important, we're going to develop what works, and we're going to deliver what lasts for your company. So what key questions are we going to be addressing today? So we're going to start off by looking at, will the acquisition with DRT put at risk the company's, the fit, the for good naturally fit? Will family members like yourselves accept a financial loss of independence? On the business side of things, we'll be asking, will the business model survive an acquisition of this size? Is there need to revisit the company's sources of resilience, including governance structures? And finally, is there time to increase revenues in this time of uncertainty? So we're looking at the three-axis model today, and we're looking at the family, we're looking at the business, and we're looking at the ownership structure. So we can see that the family works really well together. They've got a really common set of beliefs, and the business is in its maturity. So actually where we're at the moment is a really good position during these times of uncertainty to make acquisitions, to look at innovation, continue innovation, and continuing looking at that sustainability. In terms of ownership, it's really important to recognise where you are at the moment. And the fact that you've survived 5 generations is actually a really, really big thing. After the 3rd generation, it becomes really, really challenging to keep a family together. So if we look at your company, we know you've got a long history, 125 years of history. We know we're talking about big numbers here today and lots of employees, and the level of responsibility that comes with that is cannot be understated. And when we look at DRT, we can see that DRT is a global leader in plant-based chemistry. We can see that they've got a lot to offer. There's a lot of synergies there that can assist both companies, and there's vertical integration in that as well. So what is the problem? Well, the problem simply is that should you acquire DRT? And if so, when is that going to happen? What are the contributing factors today? Well, we're looking at external factors, COVID, the pandemic, supply line disruptions, whether we need to finance the acquisition with DRT. The business first strategy is often conflicting with the business strategy. So when we look at family businesses, we know that family businesses are in it for the long term. They're not looking for a quick profit. Whereas there are business demands that do require that. So we're going to be looking at that as well. And finally, the family values. We know that your family is really, really strongly aligned with ideas of sustainability and innovation. So what are the symptoms? What are we seeing? Well, we're seeing that the family is loss of financial independence. We're seeing uncertainty in making business decisions, and we're seeing a higher level of risk. And what's the root cause? Well, we're saying that external factors such as COVID are putting stress on those business priorities. So when we do a quick Sharma's performance matrix and we look at where you are, we can identify that you have a high financial capital, but you've also got a high emotional capital. The visions are aligned and the family's aligned. And we can see that through the strong growth and history of innovation, capitalisation and sustainability, but also with the family as well. There's some real strengths there. If we look at a parallel planning model, which is our diagnostic tool, we move from left to right, and you can see where we've identified the family has been doing really well and has established. You've got really strong values, and they align really well vertically and horizontally. So the family values and the business values align in terms of sustainability and innovation. The decision of where we're going, what is the family vision, and that aligns really closely as well. And whilst with the other categories, we see alignment as well, this time of uncertainty and this time of crisis around the world means that we're going to be looking at the participation strategy, human capital, the business strategy, and financial capital. So we did a VR analysis, and we looked at what's valuable in your company. And we looked at saying that, well, you are in a really strong financial situation. And these non-financial goals align with your fundamentals as well. There's research and development, and that makes it incredibly rare. It's not imitatable. You've got 3.9 thousand patents, and your ingredients are sourced globally. And finally, it's not substitutable. Sustainability and quality are recognised, and it's really hard for other companies to follow. So finally, in terms of the challenge statement, how do we make an industry leader like yourselves in renewable and sustainable ingredients during a time of crisis, but also maintaining those family values? And Caroline is going to take us further and look at developing what actually works.
Thanks, Ben. So now that Ben's taken us through, oh gosh, sorry. Let me go back. There we go. So now that Ben's taken us through what our challenge is today, I'm going to talk you through some solutions to develop some strategies that might work for your company. And recognising, as Ben said, we're 1 year into COVID. We're all quite scared. We don't really know what the potential is for the future. And this is where in business, you can either step back and not take the opportunities, or you can really take that opportunity to thrive as a business and adapt to those changing market conditions. So that's what we want to help you through today. So the first option is don't acquire DRT. So here, this would be business as usual. You'd maintain that financial independence in the family side. You wouldn't have disruption to your dividend payments, and this would be the lowest risk option. So on the business side, you could continue doing your joint venture partnerships with DRT, so there'd still be some opportunity for innovation there. The second option is very similar to the first option, but just leaving that door open, so delaying the acquisition with DRT. This is recognising that COVID is a very challenging time, and maybe thinking that if we don't want to do it now, maybe we'll delay it for another few years, see what happens with COVID and whether the time might be right later on. So then you wouldn't be disrupting the family owners, and they could still receive their ongoing dividends as they do now. The third option would be to proceed with the acquisition as it currently stands. So this would be proceeding with that hybrid notes offering financial arrangement. So this is recognising that there's aligned values between DRT and between Firmenich. So you've got those aligned values of innovation and sustainability. On the business side, there'd be a huge opportunity for growth. So by acquiring DRT, you're doing vertical integration, and we recognise that during COVID, there might be huge supply issues. And so by actually acquiring one of your supplier, you might be mitigating some of those risks of increasing supply issues. You'll have huge new capabilities in terms of health and nutrition and cosmetics and new markets as well. And there's a huge potential to pivot using these new markets and apply your innovation tools to new potential products. So you could look into masks or developing vaccines, and you'd have all of this potential behind you with the additional resources from acquiring DRT. This is the highest risk though. So we've recognised that it's a huge financial requirement. So the £750 million hybrid notes offering to acquire DRT. Option 4 looks at acquiring DRT but with a slightly different funding model. So instead of putting in that £750 million of hybrid notes offering, you'd be decreasing that to £400 million. And so that represents about 10% of annual revenue in Firmenich, assuming that Swiss francs are approximately equal to pounds. So here we'd look at increasing the private equity stake. I guess you're all asking, well, where does that $350 million, like where's that coming from? So we're looking at increasing the private equity stake from Ardian and Takahau Capital. So we'd be asking them to put in more of their own funding, and then we'd be decreasing our funding. So this would put less financial pressure on the business and the family, so it'd be a bit of a lower risk. The positive of this is that you'd still be acquiring DRT, so you'd be obtaining all of those resources, you'd be able to innovate together and take those market opportunities from COVID. So you'd still have that huge opportunity, but just at a slightly lower risk to your family. We've plotted the COVID innovation opportunities on a BCG matrix. So this looks at where your products line in terms of your market share and the growth potential. So we've put it down in the question mark at the moment because there's a potential for high growth but low market share, but we want to move that into the star category of high market share and high growth potential. And this is where we see a huge opportunity for you in collaboration with DRT. So we've used a SAF matrix, which is the decision-making tool, and it's a weighted scoring technique. It looks at suitability, whether the options address the key issues, acceptability, whether they're acceptable to shareholders and stakeholders, and feasibility, whether they're actually practical to implement. So we've scored each of the 4 options up here, and I'll point out some of the key areas highlighted in red. So option 1, don't acquire DRT. This is scored the lowest on returns and values, with only a score of 4 out of 10, because you'd be missing the opportunity and it wouldn't be in line with your values of innovation, sustainability and growth. That does score the highest on acceptable level of risk because it's the lowest level of risk. Moving to option 2, delaying the acquisition. So this isn't in line with your core innovative values either, and you'd also be missing that risk, but you'd be missing that opportunity, but you might be able to take that opportunity further down the road. So it's still got a fairly low score overall. Option 3, acquiring DRT with the hybrid notes offering, has scored quite high on the return to stakeholders because that's the biggest opportunity for returns, but it's scored lowest, a 5 out of 10 on acceptable level of risk because it's the highest risk. And finally, option 4 scored the highest overall. So this is acquiring DRT, but with that different funding model. So getting more share from the private equity investors, but putting in less of your own funds. And we've scored that still high for return to stakeholders because you've got a high potential for returns, slightly lower than option 3, but still up there. And then a 7 out of 10 because you've reduced your risk. And then 9 out of 10 for in line with values because it's still really in line with your core values of innovation and sustainability. So now I hand over to Sim to talk through how this strategy will come into place.
Thank you, Caroline. We understand how complex and the type of decision that you're making today, and we acknowledge, Gilbert, you're not a member of this family. We know that you're tasked with heading up the strategic direction and making sure that the family members that sit alongside of you are part of this journey and are feeling comfortable with what you're doing. So thank you for bringing them along today and making them part of this. We understand communicating early, particularly as what we've learned in the past year of the pandemic, is really important. So as Caroline mentioned, we are suggesting that we acquire DRT, and we're doing that with additional investment outside of the family. We understand that there's 40 family shareholdings, and we understand the complexity that can come with that and the time that it can take to do such a complex transaction. So we want to take that into consideration, noting that we do have a lot of uncertainty, and we're at this point in time, we're not sure, and we'd like to continue working with you, understanding what type of diversity there is in the family members' incomes and how important these dividends are. So for us, this has been factored into our considerations today. So as Caroline has mentioned, the BCG matrix looks at your existing products and your portfolios and helps us understand where we can actually look to continue to innovate and grow, which, as we know, is part of the fundamentals. And as part of that, we want to explore those options with DRT. Where can we currently maximise on the health, the medical? We've considered pharmaceuticals, continuing. We can see that you've been working on getting disinfectant very generously into hospitals. How can we continue to make sure that we're not only part of that from a social impact, which we can see is coming through the socio-emotional wealth for the family, which, as we know, is the non-financial aspects when it comes into a family business, and we know that that neatly aligns into the business from an environmental, social governance point of view. As Ben spoke to you about, aligning through parallel planning, the family needs and the business needs are really important that they align. So for us, really looking at that short-term horizon, going into the innovation and growth is something that we'd like to work with you on. When we restructure the deal with DRT, as Caroline has mentioned, we want to understand, can we seek further private equity investment? And the reason why we've done that is we understand that your family is willing to make those difficult decisions to put the business first. And for that reason, we'd like to see, and we consider that having some more private equity investment in this can help diversify that risk for the family. And like we said, we're not too sure at the moment how dependent the family are on this income or whether there's diversification and what further generations are needed to support this decision and the income is going to. So for that reason, if this isn't going to be palatable to the two existing private equity investors that have come forward, we would be seeking another investor to come along, again, just trying to preserve the uncertainty and make sure that there are a number of people across this, again, to de-risk in a very uncertain environment. So for us, the reason why we came up with that figure is we understand that you are willing to go above and beyond for innovation and industry norms when it comes down to research and development. And for us, we were considering that the family shareholdings would be willing to make a similar contribution to that level of research and innovation in this type of deal. Finally, we understand the richness that comes through with governance, and we need to work that through on the family side and the business side. We know that it's on your mind whether you need to do anything differently, and for that reason, we would be considering a business vision and strategy review. We know it's on your mind that right now you don't know where the business is headed in 5, 10, 15 years, and we know that it's quite healthy to undertake strategic planning every 3 to 5 years to make sure that it's headed in the right direction. And then on the family side with management and ownership, again, we are suggesting that the existing governance structures are healthy and we want to continue to support that to continue. And with that would be the family participation to understand new generations who want to come through and be part of management. Again, Gilbert, we know that you're on tenure. We know that there would be an opportunity to work with another generation, and there may be someone in the family who'd be willing to take your place in the future. That's something we need to keep in mind. And then we also understand that given the size of this, we've got a family enterprise here, so we also need to keep in mind your wealth management. So to give you an idea around an implementation plan for short term, we know that we need to investigate those innovation opportunities, and we consider that we can achieve that in just over half a year working with you. Type of activities that we need to work through is market research into those key areas of growth. Consider those findings, capabilities that are currently existing in DRT that we can make sure would be able to maximise on this opportunity. And then the financial validation of those market opportunities. We know that the market is very unstable at the moment, so we need to keep working those numbers regularly. And then again, making sure that the family members and the family owners are comfortable with this decision. We also need to restructure that deal. So as you can imagine, it's working through with the legal team, it's working through with the existing offering to see whether or not they'd be willing to contribute that investment. And we consider that this can be done within the next year. For a longer term plan, we also acknowledge that we need to keep the family involved. And as part of that, Gilbert, you take on the very important role of making sure that you've got family alignment and business alignment. And we're suggesting that you are communicating regularly, at least once a quarter, if you're not already doing so. But you're nodding, which is suggesting you are. On the Firminex business strategy and vision, again, this is a 3-year plan because we do know that strategic planning should be done every 3 to 5 years. And you've got an idea as to where that can head. And then again, family member participation and family ownership needs to be done at least annually for a business of this size. We've also considered the risks with these solutions that we've put forward today. And the one that I'd like to highlight to you is the second. We're working with external impacts that are unknown in a generation. And the company has thrived previously on being led by family members through a time of crisis. This is a different situation at the moment with a non-family member chief executive, and we need to keep that in mind. But we do believe that the existing business structures will help you through that. So on that note, we'd like to pass it over to you for some questions.
Thank you. The judges will now have 10 minutes to ask questions of the presenting team. I invite the lead judge to begin the question and answer period.
Thank you. As Gilbert, I want to thank you for validating my strategy.
You're welcome, Gilbert.
You know my chain of pearls. This is the big kahuna. This is the big pearl, the one that I want. But the problem I have is that there are two family members to my left who are unnamed that don't agree. They feel like this is going to risk their independence, financial independence, but also governance independence. French law may require that we put someone from France on our board that is not a family member. How can I convince them that this is the right way to go, that they're going to be fine, despite giving up a little bit of their independence?
So there's a couple of things in there that you've mentioned, and then I'm more than happy to pass over to my colleagues. We too have considered that, and again, we understand that you are dealing with a large number of family members that need to be factored in. So in our first risk here, you can see that we are aware that family members will have different needs that come through, and as part of that, we'd be willing to look at an already decreased contribution, and we can already see that there's an opportunity to renegotiate that deal. What we also considered through one of the alternatives is, you'll see the second alternative here. We looked at only part of the family shareholders investing in DRT, but we understood that wouldn't leverage from your existing governance structures. So we'd be suggesting that, unfortunately, if we can't get harmony within the family, the fact that family control doesn't appear to be important, we're happy to test that assumption. We know that this is a business first company. We understand that they're willing to make those hard decisions. We'd be hoping that they'd trust the process.
One more follow-up question. Renegotiating the deal. What needs renegotiating? What aspect of this deal do we want to challenge?
You're right. So as part of that, as we've said, it's uncertain times. It gives you an opportunity to make sure it's as relevant as possible, but it's also going to make sure that you've got the right investment coming through from your other private equity partners. They would be the key things that we want to do, and we want to protect those capabilities in that health and medical and nutrition space. They would be the key things we're looking for.
All right, so let's stay with that. Your recommendation is that two groups that I understand to be in the selling entity stay in the deal as investors, is that correct?
Correct.
Given that the transaction began in March of 2020, and I think we would all agree, those of us who ran a business in March of 2020, we knew about COVID. What makes you believe that they would have any interest whatsoever in doing that, given the fact that the deal was struck when COVID had already begun? What's the justification for them taking the position that they would work with you, other than the deal you have on the table?
Great.
I guess so. When we entered the deal with them at the beginning, we identified that there were huge innovation potentials. And then now that we've progressed a little bit further into COVID, we can see that there's a huge market demand for pivoting and doing things like vaccines and masks and new innovative things. So a reason why they would still be interested is that there's that huge potential for us to really grow and for them to really recoup their wealth and their investment over time.
I think as well, Feminic built a lot of trust. They were seen to be an early mover. They made decisions before formal lockdowns were happening, and so a lot of companies would have looked to yours as an early mover, and also through the history of innovation and making savvy business decisions. You've built up a lot of trust, and that comes from both the financial side of things, but also that the investment in the human capital that you've been doing as well. I think as a company, you've demonstrated that those elements of innovation and sustainability actually build trust in your competitors.
So just real quick, real fast. So let's say they say no, and it's go or no go. What's your recommendation in the absence of an alternative financing structure?
I think we looked at this as one of our existing risks. So yeah, if DRT doesn't agree or the two private equity investors don't agree. Is that, yeah.
Yeah.
If DRT doesn't agree to the acquisition?
Correct.
Yeah. Yeah. So I guess, yeah, we try and renegotiate with possible. We looked at some other alternatives. One bit might be acquiring part of their business, so they might be open to that. They might want to sell off part of their business but keep the rest. Another option is just returning to status quo. So if they really refuse the offer, then no harm done, I guess. Your company still continues as usual, and then we could do a partnership and a joint venture with them and still capitalise on that innovation opportunity.
So at that point, you'd recommend not doing the deal versus going ahead with the deal you negotiated?
Oh, we're definitely recommending the deal, but at that lower investment rate.
But if they won't agree to that, do you walk or do you close?
We're giving you a third option, which is to go small. The reason why we didn't go down this pathway is we understand how important your employees are. We know you call them colleagues. And for us, we thought this would be just as disruptive to your employees and your suppliers. What really resonated with us is when you were working with local farmers and you said, keep selling the flowers. So for us, we didn't consider it this way, given the uncertainty in the environment.
So as a family member, and I'm one of the investors, not an employee, I'm very interested in another risk that I didn't see you addressed and wondered if you discussed. Beyond the acquisition is the integration. And we're in the middle of COVID, we can't travel, we're going to bring in a new company, they're not the same culture as us. How do you deal with integration in that environment to make sure that the deal meets our objectives?
Sure. I'll start and then I'll hand over to my colleagues. We did consider this. One of the benefits of working with DRT is we understand that you have a long-standing relationship with them. You've been working with them in partnership for 30 years. They've already been assessed so far with due diligence as having the right culture check for you. I understand it's always different when you come under one roof, but that was the other appealing factor of starting small, is you could see that it was going to be the right culture fit for your business.
And I think as well, recognising that COVID is such a time of change and innovation. So if there's a time to innovate and align with a key partner and do something really great together for the world, it's now. So that's why we think that you should capitalise on this opportunity. And we recognise that your values and you've got those core relationships there already that you can build on.
So Ben, I'm coming back to you. So you were introducing the 3 axis model.
Yep.
And you said, well, this is a family that works together and distant relatives. And then you triggered me by saying the challenge is to keep the family together. What made you make that remark? How? Because I'm Patrick, of course, and I'm part of the family. Why? What did you think that we need to be, kept together?
Yeah, I think in times of crisis, that's always going to bring up different emotions with different family members, having a certain lifestyle. So whilst the business has always come first and always directed you and gave you that sense of security, I think in these times of uncertainty, there is always going to be occasions when you question that. And so I guess our recommendation comes back to saying, trust in yourself. Trust in these mechanisms, trust in those governance structures that you've developed that have worked, and that's where that family harmony will come back. And that family harmony, as we said in the parallel planning slide, when the family's in harmony, that can directly influence the business side of things as well.
So how do you assess this family? Because is it actually a family business, or do you think that it is more like a business family that we are talking about? Because it's a big company with we've got only 4 family members in the board. So did that affect your? So how did you assess that?
I think those ideas of stewardship are still really, really strong. Like, I think even though you're not participating daily in the business and that you have employed an external CEO, I think those ideas of stewardship are really, really strong. And through all our interviews with you, that came through. And I think that's really important to protect. And as I said, when you're looking at the unique aspects of a family business, it's the family side of things and the business side of things that make a business strong.
And I'll just add to that. So you've also heard from Ben, and as we've previously discussed, it's a socio-emotional wealth. And when we get into past the 4th generation, we have members from the 4th and the 5th generation here today, it does give you that sense of connection across those generations. Distant relatives, it gives you something to talk about at those family retreats, meetings that you do, which would happen regularly.
10 seconds, not enough.